Did you know that trillions of dollars are laundered globally each year? This staggering amount of illicit funds fuels criminal activities, from drug trafficking to terrorism. The fight against financial crime requires a robust and multifaceted approach. Anti-money laundering, often referred to as AML, and Enhanced Due Diligence, or EDD, are essential weapons in this fight. Anti-money laundering, or AML, refers to the set of laws, regulations, and procedures designed to prevent, detect, and prosecute money laundering. Money laundering is the process of disguising the illegal origins of funds. Criminals do this to make it appear as though the money came from legitimate sources. AML aims to protect the integrity of the financial system. It does this by making it difficult for criminals to conceal and use their illicit proceeds. AML regulations require financial institutions and other designated businesses to implement comprehensive programs to combat money laundering. An effective AML program consists of several core components. These components work together to create a strong defense against financial crime. One key component is customer due diligence, often abbreviated as CDD. CDD involves verifying the identities of customers and understanding their financial activities. Another crucial component is transaction monitoring. This involves scrutinizing transactions for suspicious patterns or activities that may indicate money laundering. Finally, AML programs rely on reporting suspicious activities to the appropriate authorities. This is typically done through suspicious activity reports, or SARs. Customer due diligence, or CDD, is the foundation of any AML program. It involves gathering information about customers to assess their risk level and identify potential red flags. CDD typically involves verifying the customer's identity, address, and source of funds. Enhanced due diligence, known as EDD, goes a step further than CDD. EDD is required for customers deemed to pose a higher risk of money laundering. This could include customers from high-risk countries, those involved in high-risk businesses, or those with complex ownership structures. EDD involves gathering more detailed information about the customer and their financial activities. Know Your Customer, or KYC, is a crucial aspect of customer due diligence. KYC processes are designed to verify the identity of customers and understand their financial activities. This helps businesses assess the risk associated with each customer. KYC procedures typically involve collecting and verifying identification documents, such as passports or driver's licenses. Businesses also gather information about the customer's occupation, source of wealth, and expected transaction patterns. By understanding their customers, businesses can better identify and mitigate potential risks. Politically exposed persons, or PEPs, are individuals who hold prominent public positions, such as heads of state government officials or senior executives of state-owned enterprises. PEPs are considered high-risk customers due to their positions of influence and potential access to public funds. Anti-money laundering regulations often require businesses to identify PEPs and apply enhanced due diligence measures to their accounts. This includes verifying their source of wealth and monitoring their transactions for suspicious activities. Transaction monitoring is a vital part of an anti-money laundering program. It involves analyzing customer transactions to detect suspicious patterns or activities that may indicate money laundering. Businesses use a variety of methods to monitor transactions, including automated systems and manual reviews. There are many red flags that may indicate suspicious activity. These include large cash transactions, unusual transaction patterns, transactions involving high-risk jurisdictions, and attempts to structure transactions to avoid reporting requirements. By identifying and investigating these red flags, businesses can help prevent money laundering and other financial crimes. Reporting suspicious activities is a crucial step in combating money laundering. When a business detects activity that seems suspicious, it is required to report this to the appropriate authorities. This is typically done through what is known as a Suspicious Activity Report, or SAR. A SAR is a confidential document. It provides detailed information about the suspicious activity, including the parties involved, the transactions in question, and the reasons why the activity is considered suspicious. The handling of SRs can vary by jurisdiction, but generally they are submitted to a Central Financial Intelligence Unit, or FIU. The FIU then takes over analyzing the information. They may investigate further or even share the details with other law enforcement agencies. This process ensures that suspicious activities are thoroughly examined and acted upon if necessary. The fight against financial crime is a global effort. International organizations such as the Financial Action Task Force, or FATF, set standards and promote cooperation among countries to combat money laundering and terrorist financing. Many countries have also implemented their own AML laws and regulations which businesses operating in those jurisdictions must comply with. The global nature of financial crime requires international cooperation and information sharing to effectively combat it. Technology plays a crucial role in AML and EDD processes. Automated systems can analyze vast amounts of data to identify suspicious patterns and activities much faster and more efficiently than manual processes. Artificial intelligence, or AI, and machine learning are increasingly being used to improve AML and EDD efforts. These technologies can learn from past data to identify new and emerging money laundering trends and improve the accuracy of risk assessments. The methods used by criminals to launder money are constantly evolving. It is essential for businesses to stay informed about the latest trends and typologies in financial crime. This includes staying up to date on changes in AML regulations, attending industry conferences, and participating in training programs. Protecting the financial system from criminals is a collective responsibility. Governments, regulators, financial institutions, and other businesses all have a role to play. By implementing robust AML and EDD programs, businesses can help prevent money laundering, terrorist financing, and other criminal activities. By working together, we can make it more difficult for criminals to operate and create a safer and more secure financial system for everyone.